Welcome back to the deep dive. We're here again to take, well, a pretty dense stack of financial results and hopefully turn them into some clear insights for you.
That's the plan.
Today, we're really digging into V-Mart Retail Limited. We'll be breaking down their unaudited numbers for the second quarter and the first half, ending September 30, 2025. So Q2 and H1 for fiscal 26.
Right. And our goal here really is to get under the hood, see what's driving the performance of this value fashion retailer. We'll look at, the core shops, how they're expanding, and also what's happening with LimeRoad, their digital side.
Yeah, and we should probably kick off with the big headline numbers because they really do catch the eye. Q2 FY26 revenue, up 22% year-on-year, hit 807 crore rupees.
Solid growth.
Very solid. But here's the kicker, EBITDA. That saw this massive growth, 85% year-on-year in Q2, reaching 72 crore.
Wow, 85%.
Exactly. I mean, when you see profitability jump like that, 85% on revenue growth of 22%, well, it tells you there's something more going on than just selling more stuff. They must have found some serious efficiency. How'd they manage that?
Well, that huge jump definitely tells us it's a margin story, like you said. It's not just about volume. The actual Q2 EBITDA margin, it went up pretty significantly from 5.8% last year to 8.9% this year.
Okay, 5.8 to 8.9. That's a big step up.
It really is. It points towards, really good control over fixed costs or maybe some serious supply chain improvements kicking in, or probably both.
And that margin improvement, you can see it trickling down, right? The bottom line, that quarterly loss, the PAT, profit after tax, it improved dramatically, shrank by 84% compared to last year.
Yeah, it went from a pretty big loss, 57 crore, down to just a 9 crore loss. Much more manageable.
And if you zoom out, look at the whole first half of the year, H1, the picture looks even better, doesn't it?
It does. For H1 FY26, the company reported profit after tax growth of 156% year over year. Think about that swing. They went from a loss of 44 crore in H1 last year to a profit of 25 crore this first half.
Wow. From negative 44 to positive 25.
Exactly. That kind of turnaround for the half year really suggests their core business is, well, fundamentally sound, and it's recovering really efficiently.
Okay, that profit swing is a great lead-in to our first theme then. Looking at that core retail engine, how efficient are they really? Are the existing stores pulling their weight, or is it all just new openings?
No, the existing stores are definitely performing better. The metric we look at here is same-store sales growth, SSSG. For Q2, it was strong, 11%. And that was pretty consistent across both the main V-Mart stores and the unlimited brand stores they have.
11% SSSG in Q2, that's healthy.
It is. And even for the full first half, H1, the SSSG was 5%. You don't get that kind of growth from your existing footprint by accident. They're doing something right inside those stores.
And it seems like more people are coming through the doors too. Looking at memo growth, that's basically the number of transactions that jumped 23% year over year in Q2. That's a lot more people buying things.
It is. And what's really fascinating here, I think, is that they're handling this big increase in traffic and sales while also getting better with their inventory. Inventory days, how long they hold stock, actually improved slightly by 2%, down to 97 days in Q2.
97 days. So let me just translate that for you listening. They're holding stock for roughly 3 months. For a value retailer, that sounds quite efficient, doesn't it?
It really is quite lean. It points straight to, better stock turnover, maybe more precise buying. They're probably minimizing those big margin-killing clearance sales.
Right.
And managing to grow revenue fast while tightening up the inventory side. That's exactly how you get that incredible 85% EBITDA jump we started with. It all connects.
Makes sense. Okay, let's dig a bit more into the customer side for Q2. Footfall, the number of people walking in, was up 14% year over year. Went from about 17 million people to 19 million.
Or feet on the ground.
Definitely. And crucially, the conversion rate also nudged up from 45% to 47%. So not only are more people coming in, but slightly more of them are actually, making a purchase.
Which leads us neatly into maybe the most, let's say, strategically interesting part of the Q2 results, the average selling price, the ASP. Because the overall total ASP actually decreased, went down 7% year over year.
Okay, hang on. That feels backward. How can they be more efficient converting more customers, but the average amount people spend is going down?
Yeah, it seems odd at first glance, right?
Yeah.
But it's all about the mix of what people are buying. If you pull out just the core apparel ASP, that actually increased by 4% year on year.
Ah, okay. So clothes are selling for a bit more.
Exactly. The reason the total ASP dropped is likely because there was a strategic shift. They probably sold a lot more of the lower price stuff, non-apparel, maybe FMCG items, everyday basics.
So they're kind of using those cheaper items, the non-clothing stuff,
Yeah.
as like loss leaders or traffic drivers. Get people in the door for basics.
That's likely the play. They leverage that high footfall we talked about to move lots of those lower margin, high volume value items. Think staples, maybe small accessories. They act like magnets. But once the customer's inside, the core stuff, the apparel, which has better margins, is still performing well. It's even commanding slightly higher prices. That validates their main product selection and the store experience itself.
Mm.
It's actually a pretty clever strategy for a value retailer.
Yeah, that mixed strategy seems to be paying off. Okay, so the core stores are healthy, using smart tactics. Let's talk about where they're pointing that energy next. Theme 2, expansion and geography. What's the store network look like now?
Okay, so as of the end of September 2025, V-Mart had 533 stores running. Mostly V-Mart branded, that's 438, and then 95 unlimited stores.
And they're still adding more.
Oh yeah, in Q2 alone, they opened 25 new stores and only closed 2. So net positive growth. Over the first half, it was 40 open and 4 closed. Still aggressive expansion, but it looks managed.
And looking at where those new stores went in Q2, looks like a real focus on Karnataka, Bihar, and Uttar Pradesh. They got, what, 13 of the 25 new ones?
Exactly. And if you look at the performance data, you can kind of see why they might be targeting those areas. Overall, sales per square foot per month across the whole network, up 5% year over year, decent.
Okay.
But the real story, the strategic success, seems to be where they're pushing deepest into the market tiers.
You mean the smaller towns, Tier 4 cities?
Precisely. The highest growth in sales per square foot was actually in Tier 4 cities. It jumped an impressive 15% there.
50%, wow.
Yeah, and remember, their total retail space grew 14% year over year in H1. So they're adding space, and in these smaller Tier 4 towns, that space is becoming much more productive, much faster. It really confirms that their whole value retailing model is hitting the mark with that, rapidly growing middle class in those specific, maybe underserved markets.
That does raise an interesting question, though. Why such a heavy focus on Tier 4? I mean, lots of competitors are battling it out in Tier 2 and 3. Are V-Mart deliberately going where the competition is? Well, maybe thinner on the ground, looking for that blue ocean?
I think that's a very plausible explanation. That 15% growth spurt in Tier 4 isn't just happening randomly. It suggests V-Mart is really capitalizing on a gap in the market geographically.
Right.
By focusing where, maybe infrastructure isn't as developed, discretionary income is just starting to climb, they could establish a strong foothold relatively quickly. It's probably a lower cost way to expand, less competition, and it clearly fits their long-term focus on value. It's working.
Okay, very interesting strategy there. Let's switch gears quite dramatically now. Theme 3, the digital side, specifically LimeRoad. This area, digital marketplaces, it's been tough for many retailers, right? Often needs huge investment, lots of cash burn.
Absolutely.
Yeah.
And V-Mart reports LimeRoad as its own segment, the digital marketplace.
Yeah.
Now, the headline number here is about the losses. They've managed to cut them significantly. The Q2 loss was 34 million rupees. That's a 53% reduction in the loss compared to last year.
53% less loss. That's huge.
It is. And for the first half, H1, the loss also shrank by 55% down to 80 million rupees.
So, great news for overall profitability. The digital arm is bleeding less cash. But how? Did they suddenly become super efficient online, or did they just scale back, sacrifice growth?
Well, that's the crucial trade-off they seem to have made. It looks like efficiency over volume. Because while the loss came down dramatically, the net merchandise value, basically the total value of stuff sold on LimeRoad, actually dropped, and dropped quite a bit, down 32% year over year in Q2.
Okay, wow. Down by nearly a third. So they essentially shrank the digital business significantly to stop losing so much money on it. Is that a retreat? How much is loss reduction worth if you're sacrificing that much digital presence long term?
I'd call it less of a retreat and more of a pragmatic pivot. It seems they decided the losses they were racking up chasing pure volume just weren't sustainable. The reason the loss fell so much is they slashed their marketing costs as a percentage of that NMV. So they're deliberately stabilizing the platform, pulling back from those really aggressive, cash-hungry growth tactics you often see in the digital space. Right now, financial health for LimeRoad seems more important than market share.
Right. So maybe they're not trying to make LimeRoad this massive standalone e-commerce giant anymore. It's more like redefining it as a cost-controlled digital extension, something that supports the physical stores, an omni-channel tool, rather than trying to replace them.
I think that's exactly the strategy. The synergy becomes key. They need LimeRoad, sure, to offer that omni-channel experience, maybe drive some traffic or handle certain orders, but they're clearly not going to let it drag down the hard-won profitability of the main physical retail business.
Makes sense. Okay, final stretch. Theme 4, financial structure and context. We should probably touch on a couple of accounting things that help put these, frankly, quite impressive results into context. Specifically, IND AS 116.
Right, yeah. Just briefly for listeners, IND AS 116 is the accounting standard that deals with leases. And for a big retailer like V-Mart with hundreds of stores, it makes a big difference to how rent costs show up on the books.
Right, it treats long leases kind of like assets and liabilities.
Exactly. Now, V-Mart reports their main results after applying IND AS 116, but they also provide the pre-numbers, which is helpful. And the difference is stark. H1 profit before tax, PBT, was 293 million rupees post-IND AS 116, but before applying it, it was only 29 million rupees.
Hold on, 293 million versus 29 million? That's an enormous difference. Why should we care about that pre-IND AS 116 number then? Isn't the official number the one that matters?
Well, yes and no. You care about the pre-IND AS 116 number because it gives you a clearer picture of the underlying operational cash reality. It's closer to the actual cash profit generated before the accounting rules for long-term leases kick in.
Ah, okay. So the 29 million shows the operational success before those big lease accounting adjustments.
Precisely. The huge gap between 29 and 293 basically reflects the long-term value and stability of their store leases, which are now treated differently on the balance sheet. But yeah, that 29 million figure really highlights the operational turnaround before accounting treatments. And actually, they also mentioned an exceptional gain last year, over 24 crore, from reassessing some lease terms. That also shows their store portfolio strategy is actively generating value.
Got it. But let's talk cold, hard cash. The ultimate health check, right? Free cash flow. And here's maybe the most pivotal number in the whole report for me. Net free cash flow, again, looking at it before IND AS 116, for the first 6 months ending September 30, 2025, it swung dramatically positive. Positive 266 million rupees.
That right there is the proof in the pudding. That shows the operational strategy is fundamentally working. They went from burning cash, remember, negative free cash flow of over 600 million rupees last year, to actually generating cash this year.
Minus 628 million to plus 266 million.
Exactly.
Turning the ship around like that on cash flow within a year, that's a massive endorsement of everything they're doing. The operational strategy, the inventory management, the cost control across the board. They plugged the leak and started refilling the tank.
Very impressive turnaround. And just to round out the balance sheet picture, inventories stood at about 10,441 million rupees end of September, which makes sense, stocking up for the big festive season ahead.
Absolutely. So if we were to summarize V-Mart's story for this first half, I'd say it's really a masterclass in doubling down on your core strengths. We're seeing that sustained power in their physical stores, the good SSSG, and critically, that really successful, aggressive push into Tier 4 cities.
Right.
And they've paired that physical strength with really tight control over costs, especially, as we discussed, by strategically pulling back on the spending, the subsidies in the LimeRoad digital segment. And that combination, a two-pronged approach, that's what delivered that massive swing back to profitability for the half year. They're sticking to what they know works. Efficient physical value retailing, particularly in those emerging markets.
Yeah, they really hammered home the value in value retailing. And that successful execution, especially in those Tier 4 cities, leads us to our final thought for you today. V-Mart is definitely proving that physical retail, done efficiently in the right places, still has a huge role to play. But that explosive 15% growth in sales per square foot in Tier 4 cities, it makes you wonder, how will they balance this going forward if they keep maximizing the efficiency of physical stores and maybe continue to let the digital side shrink a bit to save costs? Could that become a vulnerability down the line, especially if competitors finally wake up and see that Tier 4 opportunity? I mean, what's the upper limit of profitability you can squeeze out just by being hyper-efficient physically before you hit a wall or the competition catches up?
That's the multi-million-dollar question, isn't it?
Definitely something to keep an eye on. That's all the time we have for this deep dive. Thanks for joining us.